48 hours ago, something happened that nobody is talking about. A regulatory filing landed in a government database at 11:42 p.m. on a Tuesday night. Just one line. One single number on page 212 of a bank report. And that number means one thing. A financial crisis is about to explode. Not maybe. Not possibly. Mathematically, it's already started. Show you exactly how much money is about to vanish, when it's going to happen, and what you need to do before it's too late. This is not a theory. This is not speculation. This is math. On January 13, 2026, a $91 billion bank in Charlotte, North Carolina filed a report with the Federal Deposit Insurance Corporation. Buried on page 212, Schedule RCM Part 2. One line item, unrealized losses on held to maturity, securities, and commercial real estate loan portfolios. The number was $17.3 billion. Let me translate what that means. This bank has $9.8 billion in total capital and $17.3 billion in losses. Do the math. $17.3 billion in losses on $9.8 billion in capital. This bank is technically insolvent. Negative net worth. The only reason it hasn't been seized by regulators is because accounting rules let them hide the losses. As long as they don't sell the assets, the losses don't exist, on paper. But this isn't one bank. This is the canary in the coal mine. Here's what most people don't understand. This isn't 2008 where the problem was subprime mortgages and complicated financial instruments nobody understood. This is simpler. And more dangerous. Banks bought bonds when interest rates were near zero. Rock bottom. 0.25%. Then the Federal Reserve raised rates to 5.33% in 18 months. The fastest rate hike in 40 years. Those bonds lost 30 to 40% of their value overnight. But that's just the beginning. The real killer is commercial real estate. Office buildings sitting empty. Malls being demolished. Apartment buildings half vacant because there's too much supply. And loans on those buildings are starting to default. When a loan defaults, the bank doesn't get their money back. That's not a loss on paper. That's money gone. Capital erased. Let me break down the math. Commercial real estate loans held by U.S. banks. $3 trillion. Just loans. That's the outstanding amount. Office building loans. $626 billion. And here's the problem. 44% of office building loans are in negative equity. That means the building is worth less than the loan amount. 44% of $626 billion is $275 billion in underwater loans. But office isn't the only problem. Retail properties. Shopping malls. Strip centers. These are dying. E-commerce killed them. Retail vacancy rates are at 14.2% nationally. Total retail exposure, $480 billion. If 20% of those loans are impaired, that's another $96 billion in losses. Now add multifamily. Apartment buildings. Too much building. It's not enough renters. Rent growth has stopped. Delinquency rates doubled from 1.1% to 2.3%. Total multifamily exposure, $1.2 trillion. If delinquencies hit 4 or 5%, that's $48 to $60 billion more in losses, added up. Office, $275 billion retail, $96 billion multifamily, $50 billion, $421 billion in commercial real estate losses. But we're not done yet. Banks also own bonds. Lots of them. Trillions of dollars in bonds. They bought these bonds when interest rates were zero. When rates went up, those bonds lost value. According to the FDIC, U.S. banks are holding $620 billion in unrealized losses on securities. That's real money. That's real losses. They just haven't sold them yet. So add the securities losses to the commercial real estate losses. $421 billion plus $620 billion equals $1.041 trillion. Over $1 trillion in documented losses in the U.S. banking system. Right now. Today. Not future. Today. That's the hole in the balance sheets. But here's what makes it catastrophic. These numbers are based on current delinquency rates and current interest rates. To refinance, the property has to be worth what the loan amount says it's worth. In today's market, properties are appraising 20 to 40% below their 2021 values. So the borrower can't refinance the full amount. There's an equity gap. A gap between what they owe and what the property is worth. To get refinancing, they have to bring cash to closing. They don't have it. Option 3. Default. Walk away. Hand the keys to the bank. This is called strategic default. And it's happening right now, at an accelerating rate. When a borrower defaults, the bank takes an immediate loss. The loan is written down. The capital is erased. If enough loans default at the same time, the bank becomes insolvent. This is the maturity wall. It's not a metaphor. It's a calendar event. $936 billion in loans due between now and December 2026. Industry analysts are estimating 25 to 35% default rates. Let's use 30%. 30% of $936 billion is $281 billion in new losses. Add that to the $1.041 trillion we already have. $1.3 to $1 trillion in total losses. Over $1.3 trillion. But we still haven't hit $8.5 trillion yet. Because there's one more factor: contagion. In March 2023, Silicon Valley Bank failed. $16 billion in deposits disappeared overnight. The bank didn't have bad loans. It had securities losses. When depositors found out, they panicked. They tried to withdraw their money. The bank ran out of cash. It failed. 2 days later, Signature Bank failed. $110 billion in assets seized. Then, even though First Republic Bank had no exposure to tech and no securities losses, it still failed. Why? Because depositors panicked. They saw one bank fail. They assumed others might fail too. So they withdrew their deposits everywhere. First Republic lost $100 billion in deposits in 48 hours. The bank couldn't survive that. It failed in May. This is contagion. Psychological cascade. Fear becomes self-fulfilling. Now, in 2026, the conditions for contagion are far worse. Because the losses are visible. The headlines are everywhere. Office towers selling for 50 cents on the dollar. Malls being demolished. Apartment buildings half empty. When the first wave of regional bank failures hits, when the FDIC seizes 3 or 4 banks in a single weekend, depositors at every regional bank in America will ask the same question. Is my bank next? And many won't wait for the answer. They'll move their money to the big banks. JP Morgan Chase, Bank of America, Wells Fargo. The institutions with implicit government guarantees. This is deposit flight. When regional banks lose deposits, they have to sell assets to raise cash. When they sell assets, they realize losses. Losses trigger more deposit flight. It's a doom loop. And it cascades through the entire system. Here's the reality that regulators are terrified of. According to the FDIC, approximately 1,788 banks have commercial real estate exposures exceeding 300% of their total equity capital. 300% is the regulatory threshold for high-risk concentration. 1,788 banks. That's 39% of all banks in America. Of those 1,788, over 1,000 have exposures exceeding 400%. Over 500 have exposures exceeding 500%. These institutions are walking dead. They just don't know it yet. When the maturity wall hits, when defaults spike, when capital is eroded, regulators will have no choice but to close them. And when regulators close hundreds of banks, the deposit insurance fund gets obliterated. The FDIC's insurance fund has $128 billion in reserves. But the deposits in those 1,788 at-risk banks total $2.4 trillion. $2.4 trillion in deposits. $128 billion in insurance reserves. The ratio is 53 to 1. For every dollar of reserves, there are $53 of insured deposits at risk. The FDIC cannot cover even 5% of the potential losses. So what happens? The Treasury gets involved. Congress authorizes emergency funding. The Federal Reserve prints money. How much money? If the FDIC has to cover 30% of the $2.4 trillion in at-risk deposits, that's $720 billion. Add the capital injections needed to stabilize the banks that don't fail but are critically weakened. $300 to $400 billion. Add the liquidity facilities and guarantees the Federal Reserve provides to prevent total systemic freeze. $1 to $2 trillion. Total bailout cost, $2.50 to $3 trillion. But that's just the direct banking system bailout. There's also the economic contagion. When hundreds of banks fail or are forced to merge, commercial real estate lending stops. Construction projects halt. Developers go bankrupt. Contractors lay off workers. Property values collapse further. That creates losses for pension funds, insurance companies, real estate investment trusts. Those institutional losses cascade into the stock market. Equity prices fall. Household wealth declines. Consumer spending drops. The economy enters recession. And recessions create more loan defaults, more bank stress, more failures. The feedback loop. Direct banking losses. $1.3 trillion FDIC bailout costs. $2.5 trillion institutional investor losses on commercial real estate, securities, and equity holdings. $3 trillion. Economic damage from recession measured in lost GDP. $1.7 trillion total financial destruction. $8.5 trillion. $8.5 trillion. That's the number in the title. That's why this is happening right now. Let me walk you through the next 6 months. February 2026, the office apocalypse becomes undeniable. High-profile commercial real estate defaults make headlines. Trophy assets in San Francisco, New York, Chicago, enter foreclosure. Buildings valued at $1 billion in 2021, now worth $300 million. Regulators issue cease and desist orders. Banks given 90 days to raise capital or find a merger partner. The FDIC announces 3 more seizures. May 2026, the FDIC Insurance Fund Crisis. The FDIC has spent $30 to $40 billion resolving failed banks. The insurance fund is visibly Media starts asking questions. Can the FDIC handle this? The Treasury Secretary holds a press conference. She announces emergency funding. But the mere mention of it confirms the crisis is bigger than the FDIC can handle alone. June 2026, the big bank rescue operation. The Federal Reserve implements a new liquidity facility. They agreed to buy commercial real estate loans from banks at prices above market value. Banks offload their worst loans to the Fed. This costs $300 to $500 billion. Money created out of thin air. Inflationary. ***, July through September. 2026 ***. The zombification of the banking sector. The most vulnerable banks have failed or merged. Surviving banks are hobbled. Massive unrealized losses on their books. They stop lending. They hoard capital. Commercial real estate transactions grind to a halt. Property values continue falling. The economy weakens. Recovery takes years. Japan's banking crisis lasted a decade. We're looking at a lost half-decade. 2026 through 2030. Now let me be very clear about something. The bank collapse is not just a problem for bankers. It's a problem for every person with money in a bank account. Number 1. Protect your deposits. If you have more than $250,000 in any single bank, that money is not insured. The FDIC only covers up to $250,000 per depositor per bank. If you have $500,000 in a checking account at a regional bank and that bank fails, you will get $250,000 back. The other $250,000 is gone. This happened to depositors at Silicon Valley Bank in 2023. Large account holders lost money. The government eventually made them whole through a special exemption. But that was a discretionary decision. There's no guarantee they do it again for every bank that fails. So if you have more than $250,000 in any one bank, spread it across multiple institutions immediately. Not next week. Not tomorrow. Today. Because when a bank run starts, you won't be able to withdraw your money. The lines will be out the door. The ATMs will be empty. The online banking system will crash. You need to act before the panic. Number 2. Evaluate your bank's risk. Go to the FDIC website. Look up your bank's call report. Find Schedule RCC. Look at the line items for commercial real estate loans. Compare that number to the bank's total equity capital. You'll find that on Schedule RCIA. If the ratio is above 300%, your bank is in the high-risk category of your money. Number 3. Have cash on hand when a bank is seized on a Friday night. The FDIC typically reopens it on Monday under a new owner, but there can be disruptions. ATM cards might not work for 24 hours. Online banking might be offline. If you need cash, you should have some on hand. Not $10,000 under your mattress, but enough to cover 2 weeks of expenses. Buy $100 to $1,000 in case the system glitches. Number 4. Business owners need a backup plan. If you have payroll accounts at a regional bank, what happens if that bank fails the day before payroll? Your employees don't get paid. Your vendors don't get paid. Your business stops functioning. Have a relationship with a second bank. Have the ability to move money quickly. Number 5. Commercial real estate owners. If you own commercial real estate, understand this. Refinancing is going to be nearly impossible for the next 2 to 3 years. If you have a loan maturing in 2026 or 2027, start working on it now. Don't wait until 60 days before maturity. Talk to your lender today. See if you can extend the loan. See if you can negotiate a modification. Because waiting until the maturity date means you'll be competing with thousands of other borrowers who are all trying to refinance at the same time. Your lender will have no money left. Your deal won't get done. Number 6. Understand the bigger picture. This collapse is not an accident. It's not a surprise. It's the result of policy decisions made years ago. Interest rates held at 0 for years. Quantitative easing that inflated asset prices. Regulatory forbearance that let banks hide losses. All of it was justified as necessary. All of it was temporary. None of it was. And now the bill is coming due. The institutions that assured us the system was stable knew it wasn't. They had the data. They saw the risks. They chose not to act because acting would have meant admitting the system was broken. Now it's too late to prevent the collapse. All we can do is prepare for it. The $8.5 trillion bank collapse has already started. It started when that Charlotte bank filed its report on Tuesday night. It's happening right now in conference rooms across America. It will accelerate over the next 90 to 120 days. This is not a prediction. This is a timeline. The math is inevitable. What's not inevitable is whether you'll be protected when it happens. That depends on what you do in the next 48 hours. Not next week. Not next month. Now. Because history doesn't give second chances. It just gives consequences.